Gary's with River Rock Advisors, and he's been working with our supply chain committee really over the last year and a half or so to improve our understanding of what goes into what are the components of forecasting. He's also been thinking about this topic of forecasting for the rest of us. How do we, their solutions are often quite sophisticated, but what could we do, could the industry do, and what could we do to be better at making it kind of a common practice among smaller and perhaps less resourced publishers and other members of the supply chain. So he doesn't have a perfect answer. I think, Gary, you'd say that as well, but you at least want to outline some principles and talk about ways for folks to think about forecasting in a way that improves their operation, but doesn't necessarily break the bank.
Fantastic. Well, thank you very much, Brian. And thanks for the chance to talk with everybody again. Although I imagine everybody's kind of getting tired of it. In our prior Lunch and Learn sessions, we had some last year, as well as a conversation at the annual conference, and then again in August. And some things we've talked about were that all items are not the same, and therefore they all need unique solutions. And we talked about a number of methods by which we can calculate item level statistical forecasts. We can calculate them through a number of different methods, and we talked about tools that let us blend those together, and we can come up with consensus forecasts. And then we had one session where we talked about statistical inventory targets, where we take into consideration item-specific attributes of demand and supply to come up with optimal safety stock. We also talked about how we do detailed analysis on over or under ordering to help us come up with that optimal replenishment quantity. All of those techniques were in the spirit of something that is near and dear to us at River Rock, is coming up with that optimal balance of service, cost, and capital. And so all of these things are instrumental to come up with that optimal answer. But then Brian and Ken came back to me and they said, that's all great. Good job on the theory. The concepts make sense. But most of the people that we're talking to don't have the tools. They don't have the resources. They don't have the data. They don't have the data accuracy, the integrity that you need to make all these tools a reality. So while the concepts are great, they're not real practical for a lot of the people that we interact with. So they challenged me and they said, come back and let's come up with some concepts that anybody could implement with a basic working knowledge of Excel. And certainly, we're not going to set any world records or do anything with regards to forecast brilliance here, but let's come up with something that's good enough so we can move on. So I thought it would be good to start off with a definition of forecast. And so if I just go to dictionary.com, forecast is nothing more than a prediction or a conjecture as to something in the future. So I'm not a very smart guy, so I had to look up conjecture as well. And I found it very interesting. It said conjecture is the formation or expression of an opinion or a theory without sufficient evidence or proof. Or it's an opinion or theory so formed or expressed, or it's a guess or a speculation. So if we take a look at that, a forecast is nothing more than an opinion, a guess, a speculation with not necessarily sufficient evidence. So I said, well, I'm going to go ahead and put it in my own words. And rather than being a noun, I'll call it forecast kind of a dream. And it's really that estimation of the future. And a lot of people put a lot of time and effort and statistical tools in place, and they provide illusion of an accuracy with decimal points. But at the end of the day, a forecast is simply nothing more than a guess or a speculation. And it tends to be lucky or lousy. One of my past colleagues used to talk about that all the time, and he was never more right. Forecasts are either lucky or lousy, and unfortunately, we don't necessarily know what it'll be. So I wanted to kind of give that disclaimer as we start into this discussion to say whether we have advanced analytics, sophisticated tools, expensive software, or we just spin a wheel like at the carnival and take a guess, our forecast is simply a guess. And our goal is, let's get the biggest bang for the buck or the most juice for the squeeze out of the effort. And what can we do with some simple processes? So I wanted to kind of give those disclaimers. No matter what I put up in front of you guys, all it is another technique to come up with a lousy or lucky answer. But if we have a methodology behind it, it gives us a point of reference so that we can move forward and make continuous improvements. So I wanted to outline kind of a 4-step approach. I want to keep it very simple. So I wanted to kind of outline a 4-step approach that will help us put together a forecast. Again, it doesn't matter whether we're doing it on paper, whether we're doing it with Excel tools, or whether we're doing it with sophisticated software, you still go through these same 4 steps. So the first thing we have to do is we have to estimate a quantity of what we think the demand is going to be over a period of time. Sometimes we're guessing the forecasted demand over an annual cycle. Sometimes we might be establishing it for a rolling 18 months to support business planning. Sometimes we might be forecasting demand for the launch of a new product or for the phase out of a product. So whatever that time horizon is, it doesn't matter. We still need to come up with an estimate of the forecasted quantity. There are 2 primary methods that we can use to come up with that forecasted estimate. One I'm calling a top down, and we'll go through this in a second. And the other one is a bottom up. 2 different techniques that are very typical. There's also some middle out type of adjustments, but we're going to focus on these 2 for today. Once I have that quantity over a period of time, what I want to do is I now want to distribute that volume over periods in that time horizon, whether we're forecasting in daily buckets, weekly buckets, monthly buckets, quarterly buckets, whatever method or level of granularity is important to you, we want to take that total quantity and spread it out over appropriate time buckets. So there's 2 techniques we're going to talk about today. One is kind of a profile-based allocation, and the second is some statistical modeling, so taking advantage of some tools. That then gives us a point of reference. So if you joined in on some of our earlier discussions around forecast accuracy, we said mathematical modeling, statistical forecasting is only a means by which we take history and try to apply it to the future. And in today's fast-paced world with all kinds of volatility in both our demand, our customers' behavior, even our supply chain, supply issues that we encounter impact our ability to deliver, and that drives volatility in the demand as well. So the way we really amplify or improve a forecast, and we get closer to lucky than lousy, is we bring in what we call demand intelligence. Now, if I went out and I looked up the definition of demand intelligence, that might be an oxymoron as well, because we really don't know. But there's some insights that we're going to be able to drive and bring into that forecast. So a couple things we'll talk about today are some incremental quantities that we can bring in, and a technique I'm going to show you is by using some alternate profiles. We certainly can bring in some manual overrides, or as we learn more about our business, we might be able to do something by applying adjustments across multiple DFUs. So I wanted to pause there for a second and talk about this blue call-out box. DFU is a demand forecast unit, and that represents the level at which you're actually generating your forecasts. You will have different levels of accuracy as you go through the different hierarchies or level of detail of your DFU. I'm very good at forecasting overall business volume in quarterly buckets. I'm not very good at forecasting volume at an item level at a ship to customer from a ship to warehouse for a particular day of the week. So you have to understand what that right level of detail or granularity is for you. And I put a couple of examples in here just so you get a feel for what different types of DFUs or demand forecast units you might want to think about. So again, there's a trade-off that we go through when we sit down with our clients to say, you have to understand the level of granularity that gives you the ability to action the forecast versus the quality of the forecast it generates. The last step related to that topic is, at the end of the day, we talked about being lucky or lousy. The sooner we can start measuring it, we understand what level of confidence we have in our forecast, because I can always plan for that forecast error if I know what that forecast error is, whether I'm doing capacity planning, supply planning, inventory planning, even sales or financial planning. It helps me not just to have the forecast, but to understand what my plus or minus tolerance is likely to be. And so what we recommend for that is start maintaining snapshots of your forecast. We talk about doing it based on the source of that forecast. So we'll talk about that in a little bit. And do it by period. So if you forecast on a weekly basis, maintain a snapshot of that forecast every week. And that'll give you kind of a wealth of knowledge so that you can go back and evaluate the quality of those forecasts, not only based on the source of that forecast, but also over different time horizons, because you make different business decisions at different lead times. So it doesn't matter if my forecast accuracy is 100% 4 weeks in advance of the demand. If I had to make a decision to buy my product or initiate a print order 12 weeks in advance, that 4-week perfectly accurate forecast tells me how bad of a day I'm going to have 4 weeks from now. It doesn't necessarily help me replenish my inventory. And then at the end of the day, we want to get into a continuous improvement in a wash, rinse, repeat kind of scenario. So take advantage of those insights and those forecast quality metrics so I learn from it and I can improve the process. So before I go into each one of these, and I only have 4 slides, does anybody have any questions? All right, I'll keep going. Certainly feel free to interrupt me. Also, I'm going to toggle back and forth between the PowerPoint and an Excel spreadsheet. I didn't want to just give you PowerPoint theories and concepts anymore, as Ken and Brian told me, let's make this real. So I'm going to show you a spreadsheet that will make available to you as well. So if you want to play with any of these concepts afterwards, feel free to do that. I talked to you about step 1 is estimate the total quantity over time. A top-down method would say, I understand my volume. I gave you the example. I'm pretty good at guessing total volume at the aggregate level. So in this case, I put in an example of 500,000 units at the total level. And what I've done is I said, okay, now I'm going to allocate that 25% to family A, 45% to family B, and 30% to family C. Within each of those families, I break it down by subfamily, and then I ultimately break it down by ISBN or finished good or item number, whatever that final DFU is that you're actually allocating. What I've done here is I built a tool, and I'll jump to this in a second, that lets you enter in the values that you see in yellow, and it automatically calculates the forecasted quantities. So one of the questions you will ask is, how do I know what those quantities are, what those percentages are? So I wrote down a couple of things that we've used in the past to help us or help you actually go through kind of this top-down methodology. So sometimes we might say, what did we do last year as a barometer, and what do we think we're going to adjust it? So for a particular family, it might be same as last year plus 5%. I might want to look at similar demand activity. If I am bringing in a new item, I can say this item will likely behave like another item. So let's attach a volume to that item based on the similar item, whether that's a similar item, a similar customer that I might be onboarding, a similar sales channel that I'm now embarking upon, whatever that happens to be. We might just get manual estimates where someone from product development or sales or customers has insight, and they say, we think the volume is going to be this quantity. And again, we're going to put that down as a starting point and then measure our accuracy as we go through the process. The last thing, and this is getting a little bit more advanced, but we put it on here anyway, is we will take some historical demand. We'll run some analysis on history to come up with some averages, some trends, and perhaps some seasonal profiles. The alternate way you can do this is actually start from the bottom. So some of those things I just talked about in terms of establishing volumes, they might actually be at a particular item level. So I can enter in all of those quantities and those estimates at the item level, creating some sort of roll-ups to give me that sanity check. The one thing I don't want to do is roll up a quarter 5 times, but I think I'm going to have $1. So I want to make sure that as I put together the bottom level estimates at an item by item or subfamily, whatever that is, it rolls up to the expectation that I have for the totality of the business. So I'm going to pause for a quick second and show you a real quick tool, and I won't take a lot of time because I know I'm going to leave time for questions. Excuse me, this is the Excel version of what I just showed you in PowerPoint. And so real quick, kind of my methodology is a yellow cell is a value that you would enter into the model. Green is something that is calculated. So if I want to change my total volume to be 250,000, I can enter that and all of my forecasts get redistributed based on an aggregate total of 250,000. If I wanted to change the mix from family A to family B to family C, I'll just make this family A 30%. And first of all, you'll see family C automatically adjusted itself to make sure I add up to 100%. And I'll make this one 30%. And now product family C is 40%. The same logic works as I go through each level of decomposition. You may not have this many levels. You might have more levels. I just wanted to give you an illustration of how that works. So this was an example that I put together as how we might quickly do a top-down forecast starting from some aggregate quantity over some time horizon. Now, again, this time horizon could be an annualized number. It could be a quarterly number. It could just simply be for the launch of a new set of products. I then went through here. I'm sorry, I went too fast. And manufactured the item level forecast. So these values that you see right here represent the same values that came from that chart, also that I had in the PowerPoint, and they change themselves as we go through that top-down method. And this is kind of our starting point for our next step of the forecast. So if I bounce back to the PowerPoint real quick, sorry. Our next step in the journey is how do I allocate that demand, that forecasted demand over a given time period into whatever buckets I have. And in this case, I established weekly buckets. So a simple technique that we propose is that you establish a library of what we call demand profiles. So the way the demand profile works is it identifies what percent of the average weekly demand will be realized in a given week. So over here on the right, I have a real quick example of my library of 4 different profiles. Actually, there's only 3 profiles. I called one summer, one spring, and one winter. And then I have one which is a flat profile, meaning there is no profile that's detectable. And so what I simply do is I take this profile, I then multiply it by the total quantity that I have distributed down to the ISBN level, and it establishes this time-phased forecast for me based on the quantity that I plugged into the item and the profile that I selected. So I apologize, my colors aren't necessarily perfectly aligned, but in this example, you'll see that I'm using the winter profile, which is really this purple one. So I've assumed this shape into this demand profile. So if I go back to my Excel, what I have done, and I'll just show you how this works or where it sits in the model, I've established my 4 profiles right here at the top of this chart. And so again, what you'll see, and I'll just highlight the winter profile since that's the one we're looking at. I've got 52 weeks and I've got numbers that are above and below 100%. When I get to the end of the week or end of the year, my average, probably can't see it because I can barely see it, is it averages 100%. So I'm taking my average demand, I'm spreading it out into highs and low. Here are the profiles that I showed you in the PowerPoint, and these are the ones that are in here. So I can change these profiles however I want. I can add new profiles to the list, and that's something that we do as we go through our process. And then this is where I then took, and I'll just go down to the example. We're looking at ISBN 105. My total quantity of 6,750, which came out of my top-down analysis, is spread out using this profile. And here are my weekly forecast numbers. And this would be something I could feed now into my other planning activities, whether it be an inventory planning activity, a supply planning, a replenishment planning tool, or even a financial planning tool. Any questions before I move on? And I apologize, I can't see the questions if they're in a queue. Otherwise, I'll
We'll
keep.
come, yeah, we'll come back to the questions.
Okay, great. So I'm going to go back to the PowerPoint again here. I won't go into presentation mode so I can go back and forth. What I gave you was kind of a very basic, very simple approach. This is one that I've used with many clients, not only to establish a process for them, but I've used it with clients where I've been responsible for forecasting, inventory planning, and procurement, because it gives me a simple methodology that can be rapidly applied to a lot of items. And I have a point of reference that I can then use to change my techniques, change my approach, or refine my process once I have a starting point. I wanted to call it out here. Rather than spend time today going through it, there are some statistical utilities that are embedded within Excel. For those of you that are adventurous or more familiar with Excel, or let me know if you have an interest in going through some of these, but there's a couple of simple equations that are embedded in Excel. One is a forecast technique. And so what it'll do is it'll take historical demand and generate its version of a projected future demand. It does bring a lot more volatility into it. So unless you understand all of the calculus and the theory behind it, you may not necessarily understand the output. So I advise that you proceed with caution. Another technique that we do use is something called trend, and it is also a function in Excel that we'll use to see if we can detect a trend within the data, whether it's gradually increasing or gradually decreasing. And then finally, there's an entire suite of functionality where if you were to go to your data tab within Excel, something called forecast sheet, it will analyze historical demand. It'll put a confidence factor around that forecast. And it uses some exponential smoothing techniques to actually generate that forecast. Again, I caution you against using that because it does become a black box number. So I advise that you start off with something that's much more oriented to a profile than statistical modeling. But I just wanted to alert you to that. There are some techniques that we've used in the past that might be beneficial to you. If I move into step 3, this is where we bring in the demand intelligence. So the demand intelligence, I've proposed 3 different ways, 2 of which I'm going to demonstrate today around how we can apply demand intelligence to this forecast. One is I establish what I call kind of mini profiles or event profiles. So if I were to do something like a promotion, if I were to do something like a price change, if I were to do some sort of marketing campaign, whatever that happens to be, I'll have a mini event that will also have a duration. So I put 4 different examples here in my event profiles library. And what these are intended to do is define how I'm going to take that incremental volume and allocate it over the length of the event. So in this case, the yellow event, called Z creatively, is a 13-week event. The Y event, the purple one, is only a 5-week event. And I wanted to show here where I get a very quick spike. And because of that, I'm likely to occur a decline in demand coming out of that event before I go back and stabilize. And so it works the same way as the profile I showed you earlier, where we figure out a profile, we then apply a quantity to it, and then that establishes kind of an incremental lift to my forecast. And then when all else fails, we can come in and simply make manual overrides to it. Perhaps I have some true demand intelligence of maybe some pending customer orders that are going to be come in that are not part of the forecast. I might have some competitive activity that I know is going to impact positively or negatively my forecast. I might be exploring the idea of what we call some demand shaping activities, where I'm actually changing the behavior of my customers to manipulate their demand, either increase it or decrease it, pull it forward or push it out. And so if I have any of those insights, I can manually go in and make an override. So if I just give you a real quick example of what that would look like in an Excel tool. What I did is, and I'll come down here to the bottom real quick. Here are the event profiles that I established. I just made those up. In this case, they all have to add up to 100%. So for some reason, I put in a number here It'll at least give me an alert that my total doesn't add up to 100%. And so what this says is this is how I'm going to allocate the incremental lift or the change in volume I expect through the event. So I made one of them up here and I said, I'm just going to take event Y. The incremental lift is going to be 500. And so the model allocates that 500 according to that profile. So what I did, again, sticking with our example of ISBN 1005, I simply copied and pasted that event where that event is going to occur. So if it's going to start on week 10, I copied and pasted that event with a net impact of 500 to start on week 10. And then just to kind of finish the picture here, I put in some manual overrides of 300. I am expecting 3 customer orders to come in week 22, 23, and 24. And this now becomes my resulting forecast. The numbers are here in the green, but the picture for me helps me understand what's happening. So the yellow shading is what I normally would have expected based on my forecasted quantity of 6,750 units spread out through the winter profile. We can see the effect of the event that I plugged in, the orange, so I get a little bit of a positive lift and a little bit of a negative lift. And then here are those orders I added in for 300 for those 3 weeks in purple. So this blue line now becomes the new forecast that I would pass into my inventory and supply planning activities. And then finally, because I'm belaboring the point here, the third technique that a lot of people use is something that we refer to as a multi-DFU adjustment. A multi-DFU would be something where I say all of my items in the Northeast might decline by 10%. So that's going to affect more than one item in some manner. I might apply another adjustment. Let's just say everything going to my sales channel, my retailer sales channel will increase, but only in the fall. I picked an example of a category of books that might decline for the summer, but increase. What happens is I'm attacking my item profiles or my DFUs from different perspectives with different adjustments. So that is a very common practice, and that's also where we take a simple forecasting technique and turn it into overly complex. So I do advise you to proceed with caution on this. In all honesty, this is where you very quickly get away from the simplicity or the practicality of doing something in Excel, and you want to start leaning more towards commercial software that's designed to do these kind of things. We have done these things, but like I said, proceed with caution, mostly because different items will get hit with 2 or 3 or 4 changes at one time, and we may not have intended for them to be all incremental. We might have intended them to be impacted by 1 or 2, and it gets really difficult when you say, apply this to all items except for ones that have been impacted by another change. So you get into some complexity there, but it is one of the techniques that we use. I just wanted to, I did not try to model it here because this would kind of spin out of hand. The last slide, and I promise, is when I'm all done, I want to understand how good is my forecast. And so we've got 3 proposed quality metrics that we use for measuring forecast quality. One is forecast error, and that just tells me how far off was my forecast. It's another way to give you kind of that confidence interval around that forecast. Forecast bias lets me understand when I make a guess, do I tend to be high or low? Regardless of the error, am I always up over by 10% or under? Because again, as I said, understanding the forecast error helps me utilize it better. So this will understand, do I need to buffer or dampen my expectations or amplify them based on the tendency of that forecast? Then there's a forecast stability. So one of the things that will drive planners crazy is if the forecast is constantly changing up and down, high and low, I'm not sure when to lock it in, what number to be confident in. So we'll also put a metric around that forecast stability. And when I understand those things, then I can take a look back and I can understand where I'm adding value to the forecast and where I'm adding uncertainty, noise, and perhaps even error to the forecast. So I can drive continuous improvement techniques. So I can talk to or work with the the participants that are making it better, find out what they're doing well, and let's pass that on to those components of the forecasting process that are not performing as well. It also lets me understand if I need to adjust my expectations. So what I did here is I took, again, that forecast, which is this blue line for ISBN 1005, and I put a couple of examples of the demand I actually experienced in green. So right off the bat, for the first one, I can say, it looks like I had the right profile, but I did not have the right quantity. So as I'm kind of tracking to the profile and I'm noticing that I'm consistently below the forecast, or I understand my forecast has a bias to it, I can now dampen my forecast to improve that quality of that forecast. As I look at number 2, I see that it appears that the demand is following a different profile than I thought it would. And I'll jump back to the Excel in a second, and you'll see it actually follows one of my other profiles. Or finally, the last one, where my demand is just pretty much a straight line with a lot of volatility to it, says maybe I shouldn't have any profile in it at all. So simply by looking at these kind of pictures, it'll help me understand, do I need to make a course correction on the selection of the quantity or the profile that I use to distribute that quantity. And my last illustration is, here is that example I was just showing you, and I wanted to run the different scenarios. So this was the scenario where this is what my demand actually looked like. The blue is what I forecasted. So if I were to come up to this item and say, you know what, it looks like this was a summer profile, I simply change that. And now you see that I'm tracking to that summer profile. I just happen to be off by the quantity estimate. So I just wanted to kind of give you a quick example of how we can look at what's actually being realized versus what we actually forecasted, and give us a visual without having to dig into a lot of numbers to understand what I would like to do. So with that, I ran a little long. Brian, it was intentional. I wanted to minimize the hard balls coming high and tight from Ken. So I wanted to at least walk through a handful of examples in the Excel spreadsheet for you guys. So with that,
Thanks.
I will stop.
Thanks, Gary. And if you want to stop sharing so that you can see some of the folks who are throwing those hard balls.
We might let Kathy do it. She was like contributing very actively in the chat here.
Well, I can ask my first question, which was, Gary, so when you say track your forecasts over time, are you talking about just once the product is launched? Because we have an issue where, well, let's just say theoretically, a publisher might have an issue where they sign a book before it's written, pay a certain advance based on the idea that we'll sell a certain number of copies. But then by the time the manuscript is submitted, it's actually confidence in sales is lower.
We usually don't pick up hitchhikers. Yeah, one of the things that, at least what I intended, Kathy, was that every time you generate a forecast, whether it's a weekly, a monthly forecast, you simply save a copy of that. Because one of the things we do is we look at what we call a lag time. So how good was my forecast 6 months in advance of it going on sale? How good was my forecast 5 months in advance, etc. So if I have all those snapshots, I can compare my actual versus what we call an offset or a lag for when I made that forecast. Because as you know, I have to make different business decisions along that product lifecycle journey, different commitments I have to make. And it's good to understand, and you just articulated it, your confidence actually decreases as you get closer to the launch. And so if I understand what that confidence is, I can at least plan for it based on the decisions I'm making as I get closer to that launch, whether it be the distribution or the deployment of the product, anticipation for a reprint, whatever that happens to be.
Thank you.
You know, the other point there is what you're doing by not reforecasting is almost guaranteeing that you're going to throw good money after bad. You're going to make that inventory decision based on like whatever the current forecast is when you need to place the order. And it may well be that you think you're going to get a lower unit manufacturing cost, but in reality, what you're doing is guaranteeing a obsolescence number that ultimately is going to impact your financials.
Yeah.
But Gary,
One of the-
go ahead.
Go ahead. One of the things companies like to do is start to hold people accountable for forecast accuracy. And certainly we'd all love to get the sales team more engaged in that forecasting process. And depending upon how I measure that, I'll play the role of a salesperson. I have no idea what demand's going to be, so I'm just going to throw wild guesses at you on a regular basis. But right when I get, I would have done it a week ago, right before I got to the end of the month, I would have changed my forecast for February, and I should have been pretty close to being accurate forecasting February on February 28th. And so normally we would say, so what, that doesn't matter, right? And it doesn't if I have to buy product, I'm planning inventory, whatever. But even though I might be inside a lead time, I still would like to see best guesses as whatever intelligence I can get, because I might no longer be able to issue a reprint. I may not be able to change the quantity of a print order I've already submitted. But the sooner I know that I'm in trouble, I at least have more levers and more options available for me than if I just find out at the last minute, or worse yet, after the fact. So it's important to make, you will always get what you measure. So if I'm always going to measure forecast accuracy at the last snapshot, you'll get garbage for 11 months of the year, then perfect December forecast. So you want to also start measuring those at that lag time as well. Thus the reason to start keeping those snapshots.
And go ahead, Ken.
No, please. I was going to change the subject. Go ahead.
Me too. I was going to say the next set of questions is all around your concept of family, Gary. And so let's see, trim size, basis weight, binding type. Is that what you had in mind, or more like a series or a type of book?
So I talked about the concept of a DFU, or a demand forecast unit. When you get to more advanced software tools, I'll just give you the visual that I have in my head. If I think about a multifaceted pyramid, the different faces of the pyramid might give you different hierarchies that you can decompose your demand. So one face of that pyramid could be something like a product, and it could be based on the content of the product. You might have a different face of that pyramid that might be based on the format of the product. I might have a different face that then gets into the sales channel. So who are my sales channel and who's my customers? I might have a different facet of that pyramid that gets into the delivery mechanism or the source of supply. When I get to that very, very, very bottom of that pyramid, I'm all the way down at the ISBN level, delivered from a particular location, delivered to another location. That's the level at which I need to do my inventory planning. However, I will tell you that as you add facets to that pyramid, as you add levels of detail to that pyramid, the complexity of managing that process becomes overwhelming.
Mm-hmm.
So my suggestion on that product hierarchy is that as you start out, certainly as you venture into your own tools, kind of an Excel-based process, I would propose you keep it simple to one hierarchy, whatever that hierarchy happens to be and however you want to decompose it. The most important portion of that is to make sure, I'm sorry, I'm pointing at a PowerPoint here that you guys are not looking at. The most important point of that is that at each level, all of my items are all inclusive and only have one parent. You'll get into a lot of complexity if you have multiple parents. So if you think about, kind of literally a hierarchy that kind of continues to decompose itself, that's the most important thing if you're going to do a top-down kind of technique. Now, there are other approaches that you can do if you have a many-to-many relationship, but we've now ventured out of, let's keep this example simple so people can go off and do this tomorrow.
So just to step back to the very beginning, you're distinguishing between forecasting what we're going to sell versus figuring out how much we're going to buy, right?
That's correct. So we kind of look at that as we look at the demand planning with our inventory planning and our supply planning. So if I have a new product and I'm just coming out, I want to understand what I'm going to sell. My inventory planning would then say, what kind of contingencies do I want to build in my inventory to compensate for the inaccuracies of my forecast? So I'll just focus on the forecasting piece of that. I'm going to carry extra inventory. So if I'm forecasting 1,000 for a half year, my inventory plan might say, I want the 1,000 plus another 25%. So how much I buy now is going to tell me I need to buy 1,250. Now, depending upon the economics of what I buy, how I buy it, where I buy it from, I might want to buy the 1,250 all at once. I might want to split it into 700 and 550. My economic order quantity might actually be 1,500. So in some cases, I've seen scenarios where I only needed 1,250, but it's cheaper to buy 1,500 and throw 250 away. Certainly not the most environmentally friendly, but if from an economical perspective, you do encounter those alternatives that you can think about. Additionally, if it's not a hard stop on the time horizon, then I will continue to evaluate my inventory position, which will dictate my supply plan that may or may not be perfectly aligned with my forecast.
So the other thing that is related to this is returns. Do you forecast and buy off of net returns, or do you of net sales, or do you forecast gross and then view return?
In the past, when I forecasted returns, I treated that as kind of an alternate supply stream. So I still want to forecast the demand going out the door because that gives me the ability to do kind of that cause and effect. So I'll still know what's going out, but my returns really become a basis for supply that I'm going to reintroduce. If it's returns that are going to not result in sales, then I want to subtract those out for financial planning. But from a physical product supply perspective, I still had to fulfill that demand in the first place. So I need to make sure that I've accounted for that in my inventory and my supply plan.
One of the questions that came in, thank you for that. One of the questions that came in was, how do you build these profiles? Given that we've got a lot of ISBN level information, how do you build them?
Is this lunch to learn about being smart or being honest? Tell me that, Ken. So in the honest way, what I've done is I've identified items. I can't do it because I don't know my clients' items as well as they do. So if I were in your shoes, I identify my items that I anticipate are going to behave in a similar fashion, whether that be based on the format of the book, the targeted customer base of the book, or the time of the year that it's launched. I'll then aggregate historical demand for all items that fell into that same category. And in all honesty, this is the honest part of it, I'll project that aggregate demand up on a whiteboard, and then I will draw a line to smooth out smooth out a curve through all of the noise of the ups and downs of all the items. And I'll establish that as that profile. I'm not trying to perfectly predict week over week over week because you'll never get that right. I'm trying to look for the smooth trend between those items. From a Act Smart perspective, one of the things that we have some tools where we'll build a profile, we'll build those hypotheses, and then we'll go back and do a fit analysis to say, does this item fit that profile or not? And so from a mathematical perspective, we'll do that. But from a practical way, as I've done it with my other clients, we aggregate history, we put it on a whiteboard, we draw the curve, and then we try to mirror it with an Excel curve.
If I could elaborate on that question, I mean, we have some ideas about how our backlist might chunk up and behave, but our intuition and reality may not always align. So do you have a method to help be agnostic as to what the the profiles are and let them grow organically out of the data that you've got?
So I'll tell you that we've tried to take advantage of some machine learning and some AI tools around some clustering data, where we just kind of throw all the items into a basket. We assign attributes to that might be leading indicators of what profile would fit what item. And I honestly haven't been successful at having that work in a reliable way. So the closest that I've been able to come is first start with a hypothesis of, I believe these items all behave the same way. We do have some statistical tools that we then use to understand, do each of those items fit? And so what we'll find is, I thought these 25 items are going to fit profile Y. And when I do that analysis, I'll find 3 of them don't belong. 2 of them are better fit to profile Z, and 1 of them better fits profile X. So we'll kind of go through that give and take on diagnosing a profile and degree of fit until we're comfortable. Again, as we said earlier, our forecast can be lucky or lousy. We're just trying to get as close as possible.
It's interesting to recall that the way that Random House, PRH, does their forecasting is they just do straight trends. They don't even worry about the patterns and so on. And so it's not a, I think the key is to just get something going and improve on it.
We do try not to over-engineer it. That's why I'm very much a fan of kind of the Excel tools and kind of the components that we highlighted, and not diving into the complexities that people think they want. But it kind of puts you in a point of a death spiral where you never figure it out.
There was a question about whether they're AI-based or AI-informed applications that do this kind of work.
There are. We've spent time with some people that do that. It does take a lot of historical data. So one of the premises kind of going into our discussion here is, forecasting for the rest of us when we don't have that level of data and that degree of accuracy. One of the companies we've worked with will actually take a lot of data. They'll let the machine learning flush out what those attributes are and the causal factors. But like I said, it takes a tremendous amount of data. It often generates a forecast that is constantly reacting rather than necessarily being proactive. So it tends to be playing catch up quite a bit more, at least the scenarios that we ran through with them.
So any other questions? I think we've run through most of the ones in the chat. I might have missed 1 or 2. So any other questions on people's minds here?
Hi, this is Mark Cirillo. I actually had one in the chat, which is, I guess, more of a technical or logistic question, but this is Excel based, and I know some companies are kind of not using Microsoft Suite and they're using Google Suite. So can these tools be adapted easily for, say, Google Sheets, or would they not work, or some of it might work?
I'll ask you the quick question. Do you have a VLOOKUP function in Google Sheets?
I don't. Do we? Okay, because I was just kind of asking hypothetically.
Okay. So the only math that I have in this tool that may not move over from Excel into a Google Sheet, there's a newer function in Excel called an XLOOKUP. It works just like a VLOOKUP or an HLOOKUP, but it's not as restrictive. That I don't know. I haven't used the Google Sheets. That would be the only one in question. But if you had a VLOOKUP, then everything that is in the Excel spreadsheet you could use, because it's not rocket science math.
Okay, thank you.
I'm sure there are folks on here that have questions. I could always just reach in here and ask, grab somebody by name.
Everybody's going to jump off.
Yeah, everybody's going to bail.
Yeah.
Um,
So I will I will send to Brian and Ken the presentation and the Excel spreadsheet. Feel free to play with it. Feel free to email me, call me if you have any questions. Be happy to give you some thoughts, answer some of the questions offline if you prefer to do it in that manner after you get a chance to digest some of it.
Gary, that's really kind of you and a real benefit for everybody who's on the call today. And we'll be sure to include your contact information in that as well. Brenda did just add in the chat that in Google Sheets, XLOOKUP is a modern and flexible alternative for VLOOKUP. So it looks like it is fully supported.
Super.
Very good. All right. Well, thank you everyone for attending. Gary, thank you for putting this together and walking us through how it could work. I'm looking forward to trying it out.
Thanks everybody for your time.
Thank you.